policymaking is about identifying and addressing risks. And the most significant risk we face is a workforce that's scarred by a long period of unemployment. People being out of work, not able to find jobs, can have a permanent effect on their well-being. I think that's the most significant risk. Is there a risk of inflation? I think there's a small risk, and I think it's manageable. I don't anticipate that inflation is going to be a problem, but it is something that we're watching very carefully.
From the Treasury Secretary, Janet Yellen, again, this time she's speaking at a Wall Street Journal CEO conference, and it appears, Wilfred, she's walking back a little bit. What she said earlier at the Atlantic conference, which was front and center for investors today, saying that she thinks that we might have to see higher interest rates to prevent overheating. Well, now the Treasury Secretary says she does not anticipate that inflation will be a problem in the U.S. economy. Treasury Secretary Yellen also saying, aside from some transitory, that's the Fed's word, increase in inflation in coming months, I don't think there's going to be an inflationary problem.
Madam Secretary, what's your advice then to the employers who say they are having difficulty hiring workers? One suggestion has been made to perhaps raise wages, but if businesses have to compete with plussed up unemployment benefits, won't that result in an increase in consumer prices and touch off an inflationary cycle that so many experts have been worried about?
Well, I really doubt that we're going to see an inflationary cycle, although I will say that all the economists in the administration are watching that very closely. As my colleagues have said, the CEA put out a blog post on this. We expect somewhat higher inflation over the next several months for a variety of essentially technical reasons, because of something called base effects that in year-over-year comparisons right now, the months in which prices fell the most are moving out of the average, and that leaves us with the months in which they were rebounding toward more normal levels. But that's a transitory thing. I believe it's transitory, but I don't mean to suggest that these pressures will disappear.
Have you stopped using the T word, the transitory word, which we don't hear as much from Fed Chair Powell and some of the other Fed members? Are you still using it?
Well, I think it's still fair to use it in the sense that even if it doesn't mean a month or two, it means a little bit longer than that. I think it conveys that the pressures that we're seeing are related to a unique shock to the economy. And as the United States recovers and as vaccinations proceed globally and the global economic activity revives, that pricing pressures will ease.
Very, very briefly, don't filibuster me on this one, please. But last time you appeared here with Chair Powell, you had claimed you felt inflation was, at that point, transitory. Do you still believe that today?
So,
very short, please.
I think when I used the word transitory, I was thinking that it's related to the pandemic, and that when the pandemic goes away, that will make a big difference.
Do you still believe it's transitory?
That. I believe that the pandemic, unfortunately, has been and will be longer lasting than I anticipated.
So you still, basically you're saying the pandemic is still happening, therefore that's why we're still seeing inflation.
I think I was wrong then about the path that inflation would take. As I mentioned, there have been unanticipated and large shocks to the economy that have boosted energy and food prices, and supply bottlenecks that have affected our economy badly that I at the time didn't fully understand.
Meanwhile, bruh.
Oh, right. Today is Sunday, June 5th, and this is a recap for the stock market activities last week and an outlook for the week to come. Folks, I got a good one for you tonight, and I don't know if you heard this study or not, but it says high testosterone males are more likely to abandon their sons, who thus become high testosterone males in their turn. This may become a vicious cycle, so if you want to make your kid into a man, just leave him alone. Literally. But speaking of testosterone, you know what I did this weekend? I finally gave up and watched the Top Gun Maverick movie. And you know what? It turns out it's a great movie. It was kind of escapism. Feel good about America for a moment. In fiction, of course, because in reality, we're beyond Although the ending, they went a little far with it. I know we need our confidence restored, but you didn't need to stroke our cocks that hard. Like, make it believable at least. Maverick dies and he became a hero, show the flag, cut the credits, goodbye. But this movie doesn't only make you feel good about America, it makes you feel good about aging. You got a 60-year-old Scientologist doing action movies. And we got an 80-year-old president. Nobody cares about being young anymore. It's all about getting old. That's where the real action is. And I know what the ladies are going to say. Oh, that's all for men, right? Men age and people still respect them, yada, yada, yada. But society throws women in the trash once they hit 40. Not true, because you got Jennifer Connelly in the movie, and she's in her 50s, and she still look hot as shit. So there you go. 50s are the new 20s. 60s are the new 30s. I cannot wait to become 80 so I can be a real superstar. But you know, this Top Gun Maverick is destroying everybody else. For example, you got Morbius. That's a bomb. It only got 85 grand on Friday because, once again, Top Gun Maverick #1. Nobody wants to see anything at all except Top Gun Maverick. Matter of fact, it was the first movie I saw in a theater in years. So there you go. And yes, the movie theater was packed. You get your tickets, $25 each, with the popcorn, $20 each. Now you're spending $100 to watch a movie. But the theater was packed, and I know what the apes are gonna say. So now you're a believer in AMC, bro, right? Different story. You got the business, you got the stock, you got interest rates rising higher, the company has an insane amount of debt, Maverick or no Maverick, it's going down. The only hope is that one of the two giants, Netflix or Amazon, is going to acquire the company. But they're not going to buy it right now, they have to see the valuation go down dramatically. And these two companies, by the way, are facing their own problems, Netflix and Amazon. But what's really interesting is, my wife said, why do you say that the economy is going to go bust when you see all of these people all over the place? People are spending and splurging and watching movies and going to dinner. And I say, listen to what Jamie Dimon said, the hurricane analogy. Now, Dimon says that we don't know if this is a Category 5 hurricane or Category 1. And I say, Mr. Dimon, we know it's a Category 5. The question is it going to make a clean landing, or is it just going to brush off the coast and then move away? That all depends on the Federal Reserve. And therefore, this is what we're going to talk about in tonight's video. But before we move on, here's an update for you. I added the tip jar feature for the videos for all of you cheapies. And all what you have to do is find the thanks icon, click on that, and then leave a tip, and you can have your comment highlighted. Because,
There's the money. You're supposed to be earners. That's why you got the top tier positions. So each one of you go out to your people on the street, crack some heads, create some earners out there.
Yeah, so you guys got the top tier positions for a reason. I want each one of you to go out there and crack that tip jar, but take it easy, folks. Just the tip. Don't stick your whole schlong in there and get stuck in a jar. And if you don't tip, guess what? I'm going to send 2 fat guys with baseball bats who are going to find you, crack your kneecaps, grab your phone, log into your Robinhood account, and go all in the next Terra Luna. And you know what? You're not going to be able to do anything about it because you're going to be in a coma. So make your life easier and just leave a tip. There you go. And if you do, I'm going to release a video. And this video, I've been working on it all weekend, by the way. It's a never lose options trade. Never lose. You can't lose. And I'm kidding, by the way. I'm going to release the video either way. Whether you tip or not, you're getting the video. That's the beauty of watching the Maverick Wall Street. Now, let's move on, because I got a lot to talk about, and here it is, in focus tonight. Super bad. A dire warning from Reverend Elon Musk about the economy. Now, earlier in the week, we got a dire warning from Jamie Dimon, who came out and said that there's a hurricane that's about to hit the economy. And everybody was talking about it in the business/stock market world. Because, we got no life. So this is what we talk about. And then came another one. A Goldman Sachs executive echoed Jamie Dimon's pessimistic tone, warning of tougher times ahead. But rest assured, if you already shit your diaper, you got Bank of America CEO who came out and said, whoa, what are we talking about here? We get hurricanes all the time. I live in Florida. And of course, Bank of America CEO is saying, please, not right now. Don't freak out the stock market. I haven't dumped my stock yet. Give me a little time. And then talk about hurricanes, volcanoes, and earthquakes. But then we got another bomb on Friday, this time around from Reverend Elon Musk, who came out and said that he feels super bad about the economy, and he's about to cut 10% of Tesla's jobs. Reverend Elon offered the gloomy outlook on Friday, and as a result, Tesla stock went down by almost 10% in a single day. And of course, the culties worship this guy as if he's God. You know, he's the smartest man alive. He's the savior. But these culties are in for a rude awakening because this guy is the con man of the century, as we know in this channel. And what's going to happen to Tesla shareholders is what happened to the rest of the pumps of Reverend Elon Musk. Case in point, Dogecoin. Same thing will happen to Tesla stock. It's a pyramid scheme. It's a pump and dump. That's all there is. But Reverend Elon is not the savior. He's not the hero we've been waiting for. He's actually just another greedy oligarch who despises the poor and the middle class. Matter of fact, Reverend Elon came out and said that the recession is a good thing and billionaires make people happy. Oh, really? And instead of thanking the American taxpayer, the poor, the middle class for building Tesla and SpaceX for him, Reverend Elon offers nothing but disdain to the poor, the middle class, and labor unions. Elon Musk thinks you're a fool, and he wants the recession so money can stop raining down on you fools. He already cashed out, he got billions of dollars, and now he's waiting for everything to crash so he can scoop all of these assets back at pennies on the dollar. As for raining money, critics were happy to point out that Musk has been the recipient of millions of dollars in tax breaks, $64 million from Texas alone, and a very hefty government loan, among other support. In other words, the guy's a freeloader. Tesla scooped up a $465 million loan in 2009 as a part of a federal stimulus package, which financed the development and manufacture of Tesla's groundbreaking Model S. In 2015, the LA Times estimated that Musk's companies had already benefited from some $5 billion in government support. And wait, when the economic crash happened, they're going to bail out Musk and his companies again to help the green agenda. Not to mention, of course, that here in California, we gave him the former Toyota Fremont factory for pennies on the dollar. Without that, Tesla would have never been possible. And of course, the souffle hired a PR firm to spy on an employee Facebook group amid unionization efforts. So there you go. This is your hero. This is the guy you're worshipping every single day. Matter of fact, Reverend Elon gave his employees an ultimatum. And perhaps this is the teaser for the 10% cuts, because Reverend Elon said either you come back to the office and you work at least 40 hours a week in the office, or goodbye. Find yourself another job. And of course, now he's receiving criticism from software companies who are accusing Tesla of having a 1950s culture. And even in Germany, where the Berlin Gigafactory resides, well, the biggest union in that country is also criticizing Reverend Elon Musk's lack of touch with reality. Now, don't get me wrong, I'm a fan of working at the office because you work at home, you get distracted, you start watching YouTube, you got the dogs all over the place, you start eating something, and then you start jerking off, and it goes on and on. But you gotta face the music. This is not gonna change. Employees, specifically the millennials and Gen Zers, want to work from home, at least for a portion of the week, and there is no escape of that. Now, rest assured, if all of this story made you freak out about the economy because you got a smart man, billionaire, Reverend Elon Musk saying that the economy is super bad and he's about to cut 10% of the workforce in Tesla, and we talked about the upcoming tsunami of layoffs, by the way, in this channel, rest assured, Reverend Elon Musk flip-flopped once again once he saw his stock going down 10% in a single day. Perhaps Reverend Elon is done with the put options on his own stock, and now he's switching to calls once again. Because after emailing employees about job cuts at Tesla, well, Elon Musk now says the total headcount of the company will increase. And perhaps Elon is freaking out because remember the Twitter scam? that he's going to buy Twitter and give us freedom of speech. Well, the smartest guy on the planet, your hero, your god that you worship all day, turns out to be a dummy in deal making because he overpaid for Twitter, overpromised, and exposed his own stock, Tesla stock, for the deal. And the lower Tesla stock goes, the more likely that this deal is not going to go through. Matter of fact, the waiting period for the deal has already expired, meaning Twitter was just another pump and dump in Elon Musk's many pumps and dumps. Fake promises. The robotaxis are coming out by 2019. Didn't happen. The Cybertruck is coming out by 2020. Didn't happen. Dogecoin is going to the moon. Didn't happen. And now he says he's going to buy Twitter and give us freedom of speech. Didn't happen. And probably will not happen. But the good news is Tesla shorts, Tesla bears, so far have made $7 billion betting against the stock. Now here's the bad news. Among Tesla bears who are shorting the stock is criminal Bill Gates. So who do you cheer for here in the battle between the evil oligarchs? I say pass the popcorn and let's watch these oligarchs destroy each other. What's not to like? Yet between the hurricane and the super bad analogy, I'd go with the hurricane of Jamie Dimon because the super bad analogy, well, it's super bad. He put a lot of thought into it when he said super bad, don't you think? But when we talk about the hurricane analogy, we know it's a Category 5. It is the biggest one ever, and it is out there, and it is heading our way. But for now, all what we see for now is sunny skies, nice breeze, no complaints at all. Everybody's splurging in the economy, swiping those credit cards up and down, up and down, up and down. Everybody assumes that their jobs are in the bag. But here's the problem. Is the hurricane about to make a clean hit? And if it does, then we will have the worst case scenario, a massive recession in the economy, if not a depression. But if the hurricane just brushes off and then moves away, then we're going to walk out with the least amount of damage given the gravity of the situation. Now, what will determine whether this hurricane is going to make a clean hit or not? The answer is the Federal Reserve. If the Fed acts now when the economy still has the cushion to absorb the hit, then that hurricane will make a brush, maybe a little bit of a hit, and then it's going to move away. But if the Fed remains callous about the problem and remains stuck up on their transitory approach because, believe it or not, they still believe in transitory. Actions speak louder than words. But rest assured, I got the words for you. They still believe it is transitory and it's going to go away on its own. If they continue to do this, if they stick to this path, this massive hurricane, the biggest one ever, will make a clean hit. We're going to see the eye of the storm of this hurricane. Take, for example, Cleveland Fed zombie Mister, who's finally getting hit with a dose of reality. Well, now she says it was too early to say whether inflation has peaked or not, and the Fed will likely have to take the benchmark interest rate above 2.4% to cool it down. Mister, we know historically speaking you have to take the Fed funds rate above the CPI to make an impact and kill inflation. Now, I'm not saying do that right now, but you got to get closer to that. You got to get to 5% at least. She says 2.4%. We are now at 1%. So is she and the rest of the Fed zombies going to take the Fed funds rate to the so-called neutral rate of 2.4, 2.5% that they assume it is the neutral rate, by the way. Nobody knows what the neutral rate is, but we know it is above 2.5% when you have CPI inflation of at least 8.5% in this country. And we know that the CPI is lying by nature. The true nature of inflation is at around 20%, if not more. But hypothetically speaking, if the Fed was indeed serious about tackling inflation, then they will get the Fed funds rate what they deem as neutral as soon as possible. Immediately, the Fed will announce we're getting the Fed funds rate to 2.5% immediately. Is she going to do that? Of course not. Listen to how she dances around the question, and she didn't even answer it.
President Messer, it's Kelly here, and to pick up on that point, why not try to get to neutral, this year? I mean, if it's going to take the rest of the year into next year with such strong trends, nominal income trends growing at almost 10% aggregated based on this report, shortages now we're worried about on the energy side of the equation, sure exacerbated by Ukraine, but also just driven by demand relative to supply. So why not take the funds rate up 75 basis points or a full point or try to get more to neutral in the next couple of months?
Well, we're on a path to bring the funds rate up quite a bit, right? And so as the chair indicated where he is, another 50 at the next two meetings. And I think that's appropriate. I think we've got to be moving rates up and on a path and being intentional about it and being consistent with it. And, we do know that the economy is having pressures that are exogenous to monetary policy happening as well. So really the process is bring interest rates up, keep that going, look at how demand is reacting to that. We've already seen tightening of financial conditions, and that'll help temper demand. We know that things are going to happen on the supply side. We know war in Ukraine has really, raised a lot of commodity prices, including energy. And we have the lockdowns, the COVID lockdowns in China, which also has disrupted supply chains. So again, it's both supply and demand moving. And I think the Fed has shown that we're in the process of recalibrating our policy to get inflation back down to our 2% goal. And that's the job before us, that we're going to use our tools to do that. Now, it'll take some time to get to that 2% goal. So what I'm going to be looking for is those monthly readings on inflation to see that they are starting to come down. I don't want to declare victory on inflation before I see really compelling evidence that our actions are beginning to do the work of bringing demand into better balance with aggregate supply.
So here she is. She spent 3 minutes, blah, 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 dancing around the question and not answering anything at all. The question was clear. Why not do it now, immediately? Do the 1.5% and get it out of the way. And she's like, nothing but gibberish. And what does this zombie think about the hurricane call by the CEO of the largest bank in this country? Here it is.
President Messer, you're now in the tag team portion of the interview, if you haven't noticed yet. So that's my turn. I want to ask you about some comments that have been made. Elon Musk said things are about to get super bad. Jamie Dimon from JP Morgan said we're about to have a hurricane here. And I actually have 3 questions that come off of this. First of all, how do you respond to CEOs who say something like that? The second thing is it possible that we end up talking our way into a recession in the sense that these guys have their fingers on a variety of key economic activities. And if they pull back, well, then there's going to be a pullback. And then obviously the third question is, what is your outlook in terms of avoiding super bad and a hurricane?
Right. So I don't see a hurricane.
Well, you can't see it because perhaps you need a eye exam. Remember, this is the same zombie who said inflation is transitory. Take a look.
And my baseline scenario for inflation is that we're going to have higher inflation this year, above 2%. But then as some of those constraints on supply ease, I think we're going to see inflation go back down, and we'll have to, monitor that as we go forward.
And then when she was confronted about it, that, hey, you said inflation is going to be transitory, it doesn't appear that it's going to be transitory. She laughed about it. Take a look.
And yet inflation is running pretty hotter than most people expected and lasting longer than most people, including you guys at the Fed, expected. Have you stopped using the transitory word, or have you changed the way you've thought about how long and how persistent this is going to be in our economy?
So here she is, as if it is funny that inflation turns out not to be transitory. These are the people who are leading the Fed right now. Absolute clueless fools who are obsessed with the stock market and have no regard at all to the average American because they're beholden to the banksters, the oligarchs, and the 1%. And that's all there is. And now they have a new trick up their sleeve. They talked about transitory for over a year now, and they never let it go. They still believe it is transitory. But now they have another trick up their sleeves. They think if they can talk the market into killing inflation, if they can talk the American consumer into killing inflation, if they play the cute psychological games, then they don't have to walk the walk. So if they threaten, if they talk big, we're going to crush this inflation, we're going to do whatever it needs to do, then inflation is going to get scared and he's going to go away and they don't have to walk the walk. They don't have to increase interest rates at all. You think I'm kidding? Take a listen to this corrupt former Fed president from Dallas, Richard Fisher. Take a look.
Hey, Richard, nobody wants to be...
Not down the hatches. Go ahead, please. Becky.
Well, I'm sorry. Nobody wants to be Arthur Burns, but nobody necessarily wants to be Volcker either, at least in the immediate after effect of what that means. Are those his only 2 choices here? Because we are grateful for what Volcker did, but at the time it was really, really painful.
Yeah, Becky, you don't want to go as far as Volcker did, but Volcker had to do what he did because the things were really completely out of control. They're not out of control. They just need to be tempered down. And you don't want to be in either position if you're in that chair, or you don't want to be in either position if you're on that committee. But they did let things go too far. The horse got out of the barn.
Wait a minute here. Didn't he say that it's not out of control? And now he says they let it go too far? The guy just contradicted himself within like seconds, but it gets better. Continuing.
And now they have to bring it back. And they're going to have to do so convincingly. Remember, part of what they're doing here, if you look at what Ms. Brainerd said yesterday, I thought was very good, or what Ms. Muster said yesterday. They're talking to the market. They're hoping the market will do some of the work. I'm talking about the fixed income markets. You signal by what you say, because what you say has power when you're at the Federal Reserve. So I think it's a combination of two. One is action, delivering on those action, making clear what you're willing to do. We've never seen this before, where you announce a couple of 50 basis points, as Lael did yesterday, ahead of time, and other committee members, or the chairman saying, here's what we're going to do at the next meeting. They're giving you as much advance notice as possible. And in saying what they're saying, they're reaffirming that they mean it about inflation. So it may be, by having signaled this strong a policy, that they may not have to follow through as much if indeed the markets and the economy react to their words.
See, these fools are going to create a disaster in this economy because they continue to play games instead of doing what they have to do, what they must do. They rather play games instead. And if he was right, by the way, we already have a growth scare in this economy. The stock market is down big. It is estimated that at least $5 to $8 trillion, poof, gone out of the wealth of this economy. But are we seeing inflation going down? Of course not. And all what they're going to do is make this stagflation, because we're now in stagflation. They're going to make this stagflation get worse and worse by the day. And any economist knows that stagflation is the worst and most destructive economic phenomenon, because it is a slow death of the economy. Sooner or later, stagflation destroys everything. And this is the only way inflation goes out on its own. Inflation has always been a monetary phenomenon, and it goes out when the monetary policy reacts. But the only way it goes out on its own if it finishes its course. And the course of inflation, the main goal of inflation, is to become stagflation and eventually destroy the entire economy. While we're seeing the stock market down, the wealth impact is down. By the Fed games, we're not seeing them walking the walk and taking action. And therefore, inflation is still here. Inflation continues to move higher by the day. In reality, forget about the CPI and the manipulation. For example, if you traveled recently in any of America's airports, with the crumbling infrastructure, of course, you might have noticed that your flight got canceled or delayed. Why? Because airlines are short-staffed. They cannot find pilots, they cannot find flight attendants, and therefore they have to pay more. They have to pay more to recruit and get these pilots and flight attendants in service. What does that mean? That means wage inflation. And these airline companies continue to suffer from jet fuel costs and other inflationary costs. And they're passing all of that down to you and I, the end consumer, right now. Airfare tickets are absolutely insane. So is the Fed strategy working for now? Of course not. The demand is still high in services, the likes of flying, for example. And we continue to see more tailwinds for inflation, wage inflation in specific. How about rents? Did your rent go down because the Fed is playing games and scaring inflation psychologically? Of course not. We're seeing tenants grappling with the high increases in rents. And a lot of folks are becoming homeless by the day. They're getting evicted. They're moving out voluntarily because they cannot afford the rent hike. Rents are absolutely insane. In certain cases, they doubled and more than doubled. Here in reality land, not in the CPI, because as I've explained to you before, in order to beat inflation at this stage right now, you need 4 things to happen. You need stocks to go down. We're getting some of that right now, but not enough. We need real estate to go down. We need rents to go down dramatically. We need housing prices to go down dramatically. That's not going to happen with the Fed's psychological games. It's only going to happen when the Fed actually walks the walk and increase interest rates dramatically. And even with that, the housing bubble is not going to pop unless we see unemployment in the economy. And that's unfortunate, of course, but that's not going to happen until the Fed starts walking the walk by raising interest rates by a lot, because by doing so, employers move from capital expenditure to capital preservation, meaning getting rid of excess employees, reducing their costs. When these employees lose their jobs, Well, they cannot afford rent anymore. They cannot afford the mortgages anymore. And the so-called investors, the criminals, of course, who've been scooping up single-family homes in the suburbs to make them out into rental units, when they realize that the demand is down, they're going to start dumping these units right away because now they're stuck with a mortgage, but they cannot rent it to the point where they make a profit from the difference between the mortgage they're paying and the rent they're receiving. Unfortunately, at this stage, because the Fed has been way behind the curve, too late, this is the only way to tackle inflation. You gotta jack up the unemployment rate because this is the only way the insane level of demand in the economy is gonna stop. Are we seeing unemployment rising? Of course not. Matter of fact, on Friday, we got the payrolls, the jobs report, and it's bad news. Why? Because it was actually good news. The economy created an excess of 350,000 jobs. Now, why is this bad news? Because it is an evidence that the Fed strategy is not working at all. If the Fed strategy had been working, we would have seen the unemployment rate moving higher. But this is not what we're seeing, because the Fed hasn't walked the walk yet. And therefore, you saw the negative reaction in the stock market. Because right now, the stock market is saying, oh, the Fed has to do more. The Fed has to increase interest rates even more. There is no pause in September, and they have to do at least 5% on the Fed funds rate. But folks, the devil is always in the details. Remember what I said? That stagflation will destroy the economy either way. Stagflation will create unemployment either way, but it is a slow, painful death. And it all comes to the principle of the cushion, meaning right now the economy has a very low unemployment rate. Thus, the economy has the cushion to absorb the shock from the Federal Reserve. If the Fed comes out next month, or right now, better yet, and says, you know what, we're jacking interest rates right away to 2.5%, what we deem the neutral rate. Is there going to be a negative reaction in the economy, and maybe we will see unemployment moving higher? Yes, but this is exactly what we need to see at this point. The silver lining, though, is the damage would be minimal as it can be at this stage, but inflation is going to weaken dramatically. But if the Fed waits for stagflation to do the job, they're going to realize that yes, the economy is weakening, we're losing jobs, but inflation is not moving down by a lot. Matter of fact, maybe it's increasing, thus stagflation. And by the time they realize they have to increase interest rates either way, guess what? The economy lost that cushion because at that stage, the unemployment rate would be at 4, 5, maybe 6% on its own. Stagflation did the job, but stagflation did not kill inflation. So now the Fed has to react too late with no cushion. And by doing so, they're going to crash the economy into a massive recession, if not a depression. Look at the devil in the details and what stagflation is doing to this economy. On face value, the economy is creating jobs. For example, the ADP report for the private sector of the economy, it says that the economy created 128,000 jobs in the private sector alone. So far, so good. But here's the devil. Small businesses lost 91,000 jobs last month. So the majority of job creation was in the medium to large businesses. So stagflation is already hurting who? It starts with small businesses. They start to lose jobs. Then the mid-size. Then the large-size companies. But there is no guarantee that inflation is going to go down. Inflation is only going to go down when the Fed reacts. According to the ADP employment report, the goods-producing sector of the economy created 24,000 jobs in May. But here's the devil once again. Construction lost 2,000 jobs. Likewise, when we talk about the services sector of the economy, which is keeping the economy holding for now, well, we lost 2,000 jobs in information, even though, all in all, the services sector of the economy created 104,000 jobs in May. And we're seeing more and more companies pausing hiring and then rescinding offers, and the next step will be laying off. Case in point, Coinbase. They're already rescinding offers. Now, what about the payrolls, the jobs report from the government, the private and the public sectors combined? Here it is. The economy created 390,000 jobs last month. The unemployment rate was at 3.6%, and the average hourly earning went higher by 0.3% monthly and 5.2% annually. The labor force participation remains at 62.3%, meaning the economy is still short in recovering the labor force participation rate. Now, here's the devil in the details. While the headline number looks good, 390,000 jobs in May. Here's the details. Stagflation is destroying retail. For example, retail businesses lost a little over 60,000 jobs last month. Now, as we continue to see the goods sector of the economy slowing down, the next step would be losing jobs in the transportation or warehousing, and then construction, the manufacturing, etc., etc. And next, it's going to be the services sector of the economy that will experience job losses, and then we will see the rapid pace of layoffs in leisure, in hospitality, and then the unemployment rate will move higher. But there is no guarantee that inflation will go down if stagflation does the job in creating layoffs. But if the Fed acts now by creating the layoffs right away, the layoffs will be a lot less than what stagflation will do in the long run. And on top of that, inflation will go down. So layoffs will happen either way. Do you want to get it the slow, painful way of stagflation? Or do you want to get it right away by the Fed? But the beauty is inflation is going to go down. And by the way, here it is. The services sector of the U.S. economy expands at the slowest pace since early 2021. It's going to happen. It's inevitable at this point. But of course, don't expect the genius at the top of the Federal Reserve, criminal Jerome Powell, to understand any of this. He says he wants to be Paul Volcker. Meanwhile, he's not even qualified to be dog catcher, let alone Paul Volcker. But the good news is, the Biden administration is suffering tremendously. And after the midterms, they're going to purge. And in this purge, there are going to be a lot of casualties. Namely, Janet Yellen, the senile leader who got it wrong from the get-go. Well, Janet Yellen is going to lose her job, 100% in the bag. And we're going to see more of them. And of course, the energy secretary should be one of them, that delusional madwoman whose answer to the insane gasoline prices is laughter, and oh, poor you, get yourself an EV. So let's hope after the Democrats get absolutely crushed in November, that the Biden administration will wake up and start getting rid of these incompetent fools. And perhaps the Biden administration will also get rid of the top incompetent fool himself, Mr. President. But anyhow, if any of that scared you away and you say, what's up with the FUD bro? What's up with the perma bear talk? Rest assured, you don't have to listen to the facts. You can listen to the pumps by the Wall Street predators. For example, we have another one here. Wall Street is panicking about a recession, but consumer spending and cooling inflation means it's not going to happen, a U.S. strategist argues. And rumor has it, the U.S. strategist is deaf and blind. And I should say actually stupid, because we have disabled people who have more enlightenment than these morons. Now, folks, in the interest of time, I'm moving on to the charts analysis right away because there was no notable action in commodities. Oil is higher, so there is no peak inflation. Inflation continues to move higher. No notable activities in the options market, so we're not seeing an increase in participation in buying calls, for example. Likewise, when we talk about the heat map analysis, it was rebound week. All in all, the indices are all in the green, yet we had the hiccup on Friday due to the payrolls. Whether that's going to stick or not, I think the charts are going to tell the story a lot better. So let's do that, and we start with the SPY, the S&P 500 30 minutes chart. We got a gap down in the morning. The negative reaction to the commentary from Musk, and of course the payrolls came out hot, and therefore the market is saying, well, the Fed has to be more hawkish. So we got a gap down in the SPY, forming a bear flag for now, but be careful here, because the chart did not lose support of 410 at all. The chart remains within range. 410 as support, 416 as resistance. Nothing changed here. The confirmation would be losing 410 as support, and then we see, better yet, 405 lost the support. Then we're talking that this bounce is probably over. But for now, who's to say that on Monday, now that Musk rescinded the super bad commentary, maybe the S&P will resume the bounce higher all the way to the end target of around 4,300. Maybe. You cannot bet against the SPY looking at the chart right now because nothing has changed. You got to lose more support before you say, okay, this has stopped, or we're not going to resume the bounce again. What about the daily chart for the continuous contract for the SPY? Similar story here. The chart did not lose support at 4,100. Yes, it was a down day. Yes, we saw massive declines in big cap names, the likes of Apple and Tesla, but nothing changed all in all, technically speaking. The volume was still down below average. The momentum indicators are indeed weakening, but we're not seeing any reversal signal at all. Now, If the chart loses 4,100 as support, then the next support is 3,960. If the chart fails to rebound from that point on, then in all likelihood we're seeing more weakness and we will see the resumption of the selling once again. But for now, the pattern of the chart from a daily chart perspective is bullish consolidation above 4,100, going back and forth, asking for buyers to do what? To pop higher in the next leg higher. Now, if the buyers don't show up, they're freaked out by Elon Musk's commentary or by the payrolls, then the chart loses 4,100 and you know that the psychology is changing. Similarly, when we look at the SPX, the cash index, again, it is bullish consolidation. Yes, the chart lost 4,114.65, but this is not a big deal. The chart's still above 4,000 and it has yet to close the gap at around 4,056.85. Now, if the chart goes down, closes the gap, and it rebounds higher again, this is still bullish behavior. If it closes the gap and then it goes down all the way to 4,000 and it loses 4,000 as support, now we're talking about there is no resumption of the rebound and perhaps we will see another leg down. Here's the Qs, the Nasdaq, from a 30 minutes perspective. Again, we got a gap down similar to the SPY, but in this case it's a lot weaker because the chart lost support at 307.41. We have a bear flag, but we got support at 299.29. Better yet, I'm going to wait for 297.5. If that's broken, then we know that the rebound is over and we have lower lows to go, at least all the way down to 285. But for now, looking at the chart as is, we don't have a confirmation that we will see a resumption of the selling from Friday. It all depends on the psychology right now. Who's going to win? The folks who are taking the payrolls and the Fed has to do a lot more, and the commentary from Jamie Dimon and Elon Musk, or those who say that the technical rebound did not finish its target yet. Here's the daily chart for the continuous contract for the Nasdaq. Unlike the SPY, this is a lot weaker. Yes, the volume is down. Yes, the momentum indicators are weakening, but they're not down in a reversal manner. But the chart lost support at 12,766. But here's the good news for the bulls. The chart did not take the lows from the previous candle, meaning we don't have a reversal candle yet, which means this could be bullish consolidation, asking for buyers before the chart pops higher again to 13,300 at least. So the bears must not short right now until we see at least 12,207 taken out as support. Here is the IWM, the Russell 2000, small caps, 30 minutes chart, the outperformer for the week, by the way. It got a mini sell-off, a mini gap down, nothing compared to the Qs or the SPY. So the IWM remains the outperformer. It went down. It is consolidating, waiting for buyers to pop higher again above 188, which was support, now resistance. You're not going to become bearish on the IWM again until we see more support taken out. In this case, the next support is 182.81. Now, when we look at the daily chart perspective for the IWM, we're seeing higher lows. This is bullish, but we're seeing consolidation in a bull flag pattern. Now, the next resistance the chart is eyeing from a daily chart perspective is 191.5. If the chart gets all the way there, and then we see a reversal candle, then you know this is a point of taking profits and perhaps a point of placing shorts. But for now, this is not a point to place shorts until we see more support taken out. What about the Dixie, the dollar index? It appears that it found a bottom for now, but it's not decisive yet. We will know that for sure if the dollar climbs 103 as support once again. And if that happens, by the way, the equities market is not going to like it at all, because you heard the commentary from Microsoft. Microsoft is saying our profits are going to go down due to the strong US dollar. So this is not a good development for equities if we see the dollar moving higher above 103 once again. Ideally, you want to see the dollar going down all the way, losing 100 as support. But we're not seeing any evidence suggesting that that will happen, at least in the short run, looking at the momentum indicators, the RSI and the MACD. Matter of fact, the MACD indicator is showing shorter columns. In the histogram, you see these red columns getting shorter and shorter and shorter, indicating that the bearish momentum is weakening, and perhaps we will see a reversal and a start of a bullish momentum once again, and that could take the Dixie above 103. Again, that will not be good for equities, but specifically for gold. Look at gold. It made a higher low, but it went down on Friday because gold is not liking the action that it sees in the US dollar. Perhaps gold, the mature guy in the room, thought with certainty, a certain degree of certainty, that the dollar is going down by the action we got on Thursday. But then you have the payrolls coming out suggesting that the Fed has to be more hawkish. That is supportive for a higher dollar, so gold went down. Now, if gold takes the support of 1,840, then we say goodbye this is not a good look for gold. But for now, the gold bugs still have some hope here. What about oil? Brent, this is a 4 hours chart for Brent. It is popping higher regardless of what the dollar is doing because the tailwinds for oil remain very strong. We're now eyeing the previous high from when the Wall Street Journal fake news hit, and that would be around 124, 125. Another way to look at the chart is, what if this is a reverse head and shoulder formation that is playing out right now? The next target would be the previous high. Here's the 10-year yield. Unlike the dollar, and unlike the general message from the stock market that the Fed has to be more hawkish, the 10-year yield, while being positive for the day on Friday, did not pop higher in a meaningful way, and this is yet supportive for equities. But look at the MACD indicator, look at the RSI. Both of them are about to reverse negative divergences. If that happens, we see a pop in the 10-year yield, along with a pop in the dollar. You put two and two together, and perhaps the rebound in the equities market is over. Here's the TLT, a weekly chart. Is it over for the bond bugs? Not really, because what if this is an ABC pattern, which will take us higher all the way to 125.12? But this is a weekly chart, so this is a process that could take a lot of time, and it could be painful in the meantime. Here's the VIX from a 4 hours perspective. Any update here? Not really. The VIX is still holding at 24.29 as support. If we have a rebound higher from 24.29 as support, and you see green impressions in the histogram of the MACD from a 4 hours perspective, then we have a confirmation that the VIX is moving higher, the SPY perhaps already topped, and it's about to move down. Now, the confirmation for the resumption of the bounce in the SPY would be the VIX losing 24.29 as support. What about the VXN, the VIX for the NASDAQ? Again, 4 hours perspective. Any update here? Not really. We're seeing some weakness, but what if the VXN is showing a sloping line of resistance? And if that sloping line of resistance is broken and we see a pop in the VXN combined with green impressions in the histogram of the MACD from a 4 hours perspective, then we got a confirmation that the VXN is moving higher and the Q's already topped and it's about to move down, and hence no resumption of the bounce in the Qs. Here's Apple, a daily chart. What's going on here? It did not close the gap, but it retested 145 as support, and it did not lose that support for now. So the bears better be careful here. This could be a trap because who's to say that Apple is not going to pop higher again above 150? And this is just a retest to gather some energy, and then it pops higher again. Now, when we look at the volume, it went higher slightly. This is a good sign for the bears. Likewise, the MACD indicator, the RSI, are weakening, but not reversing for now. But the bears have to wait for the gap to be closed under 145. I believe it is 143.7. If that is closed, and we see Apple rebounding higher again, recapturing 145 as support, then you got your answer. This was a bear trap and Apple is moving higher. But if the gap is closed and Apple continues to move down, then you got your shorting signal all the way to at least 138.79. What about Tesla, the souffle? Here's the battle between the technicals and the fundamentals. The technicals looked good for Tesla. It was a bull flag pattern, indicating that the chart should move higher above the next resistance. So if you bought calls following the technicals based on this pattern, you did the right thing. But stocks move based on three things. Number one, fundamentals. Number two, the technicals. Number three, the mechanics, meaning options, etc. And therefore, in this channel, we cover everything: the macro, the fundamentals, the technicals, the options market, because all of these factors move stocks. It is not just the technicals alone. And this is case in point. The chart was showing a bull flag pattern, but then came the fundamentals with Elon Musk announcing laying off 10% of employees, and of course combined with the payrolls, and Tesla went down by 10%. But here's the problem for the bears. If you short now, you might eat a massive pie in the face. Why? Because 700 remains intact as support. And we talked about the daily chart of Tesla not so long ago. Even if the chart goes down to 700, but maintains 700 support, it is showing a reverse head and shoulder formation, indicating a recovery coming. The bears should not be excited to short until we see 700 taken out as support. And of course, when it rains, it pours for the souffle. It's not just the bad news from the commentary from Musk, but we're now getting more scrutiny by U.S. regulators who received 758 complaints of cars made by the company that suddenly brake at high speeds. This has been a problem specifically for the newer models. A lot of recent buyers are complaining over and over and over again. And it is becoming increasingly dangerous, not just for souffle drivers, but also for the rest of us on the road. So this is more bad news for Tesla, but again, this is just the fundamentals. Other things move this stock and other stocks too. Lastly, let's move on to Bitcoin. Tulips, what's going on here? No updates, still holding at 30,000, back and forth, asking for buyers. More buyers, not just a pump over the weekend, pump and dump. Asking for legitimate buyers, asking for risk on mode, but for now, it is not getting an answer. And if this continues over and over and over again, and the buyers don't show up, the sellers will. And it's going to be a massive down candle. So watch out here. This is a watch and see chart. If we get the pop, if we get the buyers showing up, we see more reactions and indicators that we are in risk on mode, then Bitcoin moves higher and you're going to feel comfortable buying. But if you buy now and we're not in risk on and we see another sell-off in the stock market, then we're going to see the sellers in Bitcoin showing up and you're going to eat a massive pie in the face with a big down candle. So watch out here. And now let's move on to the conclusion of this video. What do we have on the economic calendar this week? Nothing on Monday, but on Tuesday, June 7th, we have consumer credit. On Wednesday, June 8th, we have wholesale inventories. This will be a revision. And then on Thursday, June 9th, we have, per usual, the initial jobless claims for the week. And lastly, on Friday, June 10th, the most important day for the week by far, we have the most important consumer price index, the CPI, aka the CPI. And on top of that, we have the University of Michigan Consumer Sentiment Index. Friday will be the most important day by far this upcoming week, so buckle up your seatbelts. But for now, this has been your host, the Maverick of Wall Street. This is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow.
Remember, with great power comes great responsibility.